What's up, everybody? Dan Warmby with Keller Williams, West Ventura County here. Hope everyone's doing great. So, one of the biggest problems that we have right now in the housing market is affordability. With rates really high compared to what they have been, they're still not historically all that high, but they're biting into people's savings quite a bit more. People are finding that it's tougher and tougher to get to that 20% down to get rid of PMI, to get lower rates. And it's really been problematic for a lot of people. So, this week, I had a chance to catch up with Oscar Guzman. He's a mortgage broker with Premier Financial, and he was letting me know about a new program that came out yesterday called Dream for All. And it looks like it's an amazing, amazing way to get into the housing market without a ton of savings. In fact, with zero down sometimes. So let's take a look. Cool. So I'm here with Oscar Guzman of Priority Financial, and he actually reached out and let me know about an awesome program that I kind of wanted to bring to you guys and give you a little bit of a overview of because I think it's going to help a ton of people out. But first, Oscar, are you feeling what I'm feeling here? Like one of the biggest hurdles that we're facing is affordability in the marketplace?
Yeah, definitely. I mean, when meeting with families, a lot of times, it comes down to, okay, you've been working for 2 years, you have credit, you have everything that surrounds the whole process of buying the home. But definitely sometimes what's a hurdle, a challenge for the families is not only the down payment, but also obviously the monthly payment, right? Because when buying a home, you got to think about it in a monthly basis. Like sometimes, when you're thinking $4,000, $5,000, it could be like a bit of a payment shock, right? So that's definitely a reality check when going through the process. And so, that part of the reason of, this program being so great is that it actually helps you with the down payment. And because the down payment can be as high as 20% of the purchase price, that obviously offsets the your monthly mortgage payment. In addition to that, because it's again up to 20%, you can also avoid the mortgage insurance, which is also a big one, right?
Like 300, $400 a month in some cases, right?
At least. And sometimes, depending on your credit history, it could be as high as 500, 600. you know, that's why we got to look at the options between FHA, conventional, see what makes more sense for the families.
Okay. Well, cool. I don't think we talked a lot about it. It's called the Dream for All program. Can you give us kind of an overview of what the whole situation is there?
Yeah, so Cal HFA rolled out just yesterday, March 27th, the Dream for All, right? And so the main thing about it is that it targets first-time home buyers. Now, what is a first-time home buyer? Is someone that hasn't had any type of interest ownership in a single family or condo, townhome, PUD, you name it, in the last 3 years.
Is that
So
everywhere or just in California?
just in California,
Oh,
just
okay.
in California. So this program is mainly for California, and so again, the goal here is and to incentivize home ownership. Home ownership is important, and just like we talked, one of the hurdles is down payment. So the agencies is helping with up to 20% down payment. Okay. Now, what are some of the requirements? First time home buyer, credit score of 680 or higher. Okay. Obviously, we have to qualify for the home. But well, as I was mentioning, one of the great benefits is no mortgage insurance. Um, so the Dream for All really makes a difference in that monthly payment, really makes a difference for some of these families that, have the income, have the credit history, but just don't have the savings set aside for the down payment. Um,
So,
in addition to that, go ahead.
oh, I know a lot of people since this just rolled out and it was brand new to me, and a lot of people might actually have a few dollars in savings to play with if they were in the market right now. Is it possible to stack this with other things like a 2-1 rate buy down and use that.
So 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 that's actually a great question, and I actually sent an email to the agency to see if we can actually do that, because I mean that would be huge, in some cases. I know that, normally they in the past they've considered some of those options, because I reached out to them, but because this program's so new, we don't have all the details yet on it, right? But definitely I'll get back to you on that as soon as I get an answer from them, because I mean that would be great. In this regard, CalHFA, they basically set the rate. It's not something that we can necessarily negotiate. The rates are posted on their website, and that's what we use, to qualify the families. They'll post them, Monday through Friday, with the exception obviously of holidays and weekends. But the families can go in there and see, the rates that are being offered on that specific day. Also, if there is some savings set aside, it's mainly going to be used also for closing costs. There's different variations, because some families may say, hey, Oscar, well, you know what, to be honest, I don't have any savings, right? So what happens in those scenarios? We can actually do a variation where we put down 15% of the down payment and use the other five towards closing costs,
Oh, so it's
right?
pretty flexible in
um
that way.
yeah, in that way it is. It is. Again, the idea is to incentivize and to help families, with home ownership. So they've made some adjustments where they make it flexible enough to help those families.
Very cool. Okay. And I kind of jumped the gun there. I've gathered there's some other qualifications and restrictions that we know about with this program.
Yeah, so I mean, again, first time home buyer, 680 FICO score. You have to be a US citizen, permanent resident, DACA permit, or have an employment authorization card. Obviously, they have the restrictions as far as debt to income ratio, so qualifying for, your purchasing power is going to be important. um the lower the debt, the better, in all cases. It is based on, they do have income limits. Okay, so for Ventura County is 228,000 a year
For a family or for an individual?
for for an individual. So
Okay.
for whoever's applying for the home.
Gotcha.
So in every county, obviously, it is different. I can definitely share with you our income guidelines for the whole state, just in case somebody was to reach out. So I'll have that information over to you. But yeah, I mean, in that regard, the program is pretty straightforward. Again, I mean, the biggest thing is that 20%. I mean, as we
Yeah.
found out about it, it was like, whoa, like this is
Yeah.
gonna create a lot of opportunity for a lot of families.
Yeah, the PMI issue alone is keeping a lot of my buyers down into a price point where there's not a ton that they're really in love with. And so being able to get up
Sure.
into a price range that really works for them is amazing. So one thing that jumps out at me is we are kind of in this high interest rate environment right now. Well, high, I mean, as opposed to, almost free for so long. But
Sure.
a lot of people are purchasing right now with an eye towards refinancing in the future. Is that something that would be impacted by this program?
Yeah, so that's a great question again, Dan. So the program is gonna allow you to refinance once without having to pay back the assistance. Okay. So the idea there is that, yes, just like you mentioned, the expectation is that we're more than likely going to see families refinance here in the next 2-3 years, because we expect rates to settle. So the program does allow for a refinance without having to pay back the assistance, and I think we can roll into that, and I always want to have a clear message for the families. This is not free money. Okay, this is a loan. and that needs to be repaid back. When do you repay it back? You repay it back once, either you after 30 years, after you finish paying off the home, you repay it back if you refinance the home more than once. If you refinance that second time, then you have to pay it back. Now the loan is at 0%, so no interest.
Oh, that's
No
amazing.
interest is Yeah, so it's no interest. And on top of that, you will also have to share with the state a 20% of the appreciation of the property.
See, that's what I was hoping we'd touch on too, is that sticks in a lot of people's craw a little bit, but the way
Mhm.
I've been phrasing it to people is you're getting 80% of the appreciation of a property for basically 0% down. Is that the way you could look at it as well, or?
Well, there's definitely different ways, and I mean, just like you say it, yeah, I mean that's exactly it. The other way I approach it is because CalHFA gives an example of like a 5-year mark, right? Where they say, hey, if a family buys a home for 500,000, we'll put in 100,000, right? 20% of 500, so that leaves a loan amount of 400. You make payments on 400,000, and after 5 years, you decide to sell. They call Dan and they say, hey, Dan, help us sell our home. Okay, well, your home today is valued at 640,000, right? That's what we're selling it for. Okay, perfect. So that means you have an equity of 240,000, right? Because your loan amount is at 400, sales price is at 640. So the first 100 go back to the state automatically. Then what's left over, it's 140,000, which you get 20% of that, and that will go back to the state, which is about $28,000 or so. Um, that leaves the family with about 112 minus, any fees and whatnot they have to pay, right? So I mean, in a 5-year term, they could potentially be making an approximate of $100,000 with the example that we're giving, right?
Mhm.
Versus, let's say the average family is paying about $3,000 a month in rent, right? Times 12, that's 36,000. Times 5, that's probably 180,000 or so dollars, with nothing to keep at the end of that 5-year term.
Exactly. And
So
even if they purchase maybe something smaller, if that puts them down into a condo, you're not getting those HOA fees back, you're not getting that PMI back, but you're getting 80% of this appreciation. So,
definitely. So I mean, home ownership is really I always say it's a blessing, first of all, and second of all, is a great way for a family to be able to at the end of the day have something to create, not only wealth for their family, because I mean, historically speaking, homes have always depreciated, always appreciated in value. And so with that said, I mean, the expectation is that one day, I mean, it's going to be worth more than it is today,
well, and that's the
and
interesting
and that's
thing.
to their gain.
Yeah, that's a really interesting thing too. I just ran these numbers for a client of mine today, and he was very concerned about being upside down in a property, which is totally understandable. But even when we factor in like the big crash, if we go from 2000 to 2023, we're averaging over that time 11% a year, even including that big crash. So at some point, we have to say, yeah, things are in the short term, we might have problems, but if you're a 5, a 10, a 15, a 30-year time horizon, you're going to get appreciation through that time horizon.
Well, and not only that, but the thing here is that there's two different people that will buy a property. One is somebody that's obviously the owner occupied, right? It's, hey, I'm looking for my home. And then there's the investor, right? So it's two different views. If you're buying it for you, for your family, honestly, the market can do this. That doesn't matter as long as you can afford, right? Because your intention when buying the home is not, hey, I'm gonna buy it to resell it.
Hmm.
You're buying, hey, this is my home, this is where I want to create memories with my family, whatnot, right? And then when the time comes, then okay, you'll analyze the market and see where we're at.
Yeah. And if you need to,
However, you
yeah, if you need
I'm
to hold
sorry?
on, if you need to hold on for a year,
Sure.
yeah, you can do that. And especially if you're in a fixed mortgage. So,
Yeah, and I mean for an investor, well, obviously they have different eyes. They're like, hey, I need to get the best deal possible
yeah.
because I'm either trying to flip it, I'm trying to do this, I'm trying, right? So it just depends. I always tell families because that's the number one question I get asked. Is it a good time to buy? And my answer is always the same. It's always a good time to buy as long as you can afford.
Hmm.
Because, you know, down the road, I can't say if it's going to be a year or 10 years or 15 years, but you will make money at some point because it will go up just naturally. My neighbor the other day was here and he was like, Oscar, I bought this home for $64,000. And I was like, okay, well now you can get 600.
Hmm.
And so, but that's reality, that's time. And so but yeah, I mean it's home ownership it's a beautiful thing. It's something that I hope that a lot of families can take advantage of. And everybody's situation is different, and it's okay, right? We're willing to walk inside with them, inform them, provide them valuable information, and when the time is right, they can make that decision to move forward.
Yeah, and so this is also through Cal FHA. And what's been interesting historically is you know more than me, obviously, but I've always seen FHA rates higher than conventional rates. And recently it seems like that's inverted, and our Cal FHA rates are a little bit lower than our conventional rates. Is that accurate?
Well, it's been a little bit of the two, right? It's been a little bit of the two. So normally, actually, FHA rates can tend to be lower than conventional rates, but they kind of flip. So Cal HFA offers both programs. They offer both the conventional program and they offer FHA programs. Basically you can think of it as a traditional FHA or conventional, with the boost, basically, because the boost is obviously the down payment assistance and whatnot, right? So it's not, this loan specifically is not an FHA loan, it's a conventional loan. So it's a
Oh, okay.
conventional loan, that follows all those the guidelines. So in that regard, that's why we don't have the mortgage insurance as well, because with FHA loans, normally you'll always have a mortgage insurance for the life of the loan.
Yeah, and you know what's really amazing there is it just all clicked in my head there. As a conventional loan, that's one thing that some of the buyers were like, yeah, but if I'm going out there, we're up against cash offers, we're up against conventional offers right now. Coming in with VA or FHA can be tricky sometimes. Not that they don't close, but there's a perception among some sellers that they're more problematic than other loans, which in some little ways they can be, but having a conventional option like this is huge because it allows you to compete on a level playing field with other people with conventional loans that are, not against cash buyers, but it puts you at a marked advantage. And,
Oh yeah, definitely.
as a listing agent,
Definitely.
I'll look at 20% down equivalent to cash all day long.
Yeah. Well, and not only that, but that like these programs, they are stricter, in some ways. Even though they allow for a credit score of 680, as a minimum, they still are really strict with your dad. They want to make sure that you're there. I mean, this is an ideal program for those families that, again, they have the income, they have everything, they just for one reason or another they don't have necessarily the savings. But at the same time, it says, hey, well, maybe you don't have all the savings, but maybe I can help you. Here's the option, right? And so Cal HFA, I mean, is great. I remember I helped my first family, my first purchase that I did as a mortgage advisor with the Cal HFA loan, and I mean, it was amazing for them. You know, it was a family that had worked, you know, really hard for a few years, had worked on their credit, had worked on their debt, and they were ready for that next step. And they were able to purchase for, you know, I think out of pocket they did like, you know, $4 or $5,000, which, you know, it was minimal, right?
Yeah,
So, you know, these programs really incentivize those families, and not only that, but it provides opportunity. And really sometimes that's what a family needs, an opportunity to be able to, you know, become homeowners.
exactly. It sounds like this program is really geared to do that. So, well, awesome. I think you really went over it in a great deal of detail there, and I really appreciate you kind of doing a deep dive on this with us.
No, definitely. And you know, if any more questions come your way, feel free to reach out. I'd be happy to answer. Like I said, I'll get back to you on that 2-1 buy down, because honestly, I mean, if we can, you know, combine some of these things, it's really gonna make a difference for a lot of these families.
Oh, yeah. I mean, just think about if we can do a buy down and then in 2 years interest rates are back and you can do that one refinance. There seems to be a lot of ways to, if it's possible to stack this. I mean, by itself, it's amazing, but just learning about it, how it's going to fit into a lot of homeowners' plans, really makes it an option for a lot of people. It wouldn't be an option for otherwise. So that's really awesome.
Definitely, definitely. Yeah, no. So, like I said, we're available to answer any questions. Feel free to reach out, and thank you for having me.
Yeah, absolutely. Thanks for joining us.